Hello out there, David Moore, Equity Advantage, and we're going to talk a little bit about the founding of Equity Advantage and sort of the basics of 1031 and how we got started with business and proper application of it, actually. And just for future context, we're talking to you today. It's July of 2024. And at this point, Equity Advantage is almost 34 years old. 33 years old, I guess I should say, since we were founded in 1991. But it's sort of, I look back on it and time sure travels quickly. And I'm blessed to have actually my daughter in here working with me these days. And I always, if you've seen our stuff before, probably hear me say she's got the toughest job in the world to make her old man look good. But as far as we're concerned, 1031 has been around for over 100 years at this point, and it really still sort of surprises me when we get calls after the fact. Somebody wants to do an exchange they didn't understand, and it's one thing for let's say, an investor that doesn't really understand the process, the basics, what's involved. But if you're a real estate broker at this point in time, you're dealing with something that, like I said, it's over 100 years old, and you've got to sort of look at 1031s and what it really does for not just the investor, but for anybody in the real estate community, and actually, to be totally honest with you, the federal government too. And this is something that they totally lose sight of. My background was 1031 in application. My brother and I, Tom, moved from Santa Cruz, California to Oregon in 1990, spring of 1990, and that was because my father was a dentist, and one of his patients was a gentleman named Ron Stash, and Ron had founded a company called Starker Services, which in the 80s was probably the largest in the 1031 business, and he sold most of his interest in Starker when we had the World Series earthquake, and he'd been in a board meeting, went home, and his house had slid down a mountainside, so he decided he had enough of working every day, and just he'd amassed a lot of doors and was living off that. And so he was the gentleman that was sort of tasked with teaching my brother and I the application of 1031 from the consumer side. And then ultimately, when we started using it and working with it, we found that there weren't many resources in Oregon for it at that point in time. And once again, we're talking about 1990. And so we started looking at putting a company together, which we finally did in the fall of 91. So it was not my intention. I always joke. I tell my kids, I said, be careful where you move. You might end up living there, because I was, as a happy beach boy playing in the sand in Santa Cruz. And next thing you know, I'm living in outside of Salem, Oregon. And I end up meeting a girl and starting a business. And here I am all these years later. So you sort of look at 1031, and we've really gone through an evolution of the not the code necessarily, but the people that are playing in that code. And I would say that in the early days, most of the practitioners in the space were people that had tax or legal background, or they were coming from the application side, but they really understood what was going on there now. And it sort of evolved into an additional consideration at closing. And that happened because you've got a situation where now you've got national title companies put side corporations together to handle an exchange, and they can do that just fine. But when it comes to the nitty-gritty of it, or picking up little issues, fine nuances, understanding why people are doing this thing, and understanding it's not really that transaction. It's not a transactional relationship. It's an investment relationship for a long period of time. We like to say it's not a tax or legal decision. It's purely an investment decision. And we really want to look at these transactions when we get into them. And number one, does it make sense? Because 1031 does have an opportunity cost associated with it. But I was taught, like I said, from the application perspective, and so when my brother and Tom and I put this thing together, we really put it together, one, because we just saw that need for the process and somebody to handle it in this region. And by the way, it really doesn't matter in today's world. I'm sure you're aware that 1031 is a federal tax code. It's not a state tax code. Different states may handle things differently, and you've got to be working with people to understand that. But it really doesn't matter where the exchange company is. You're going to be able to handle transactions all over the country, and really, we can't do deals domestic to foreign or foreign to domestic domestic, but we can actually do transactions offshore also. It's just foreign for foreign, domestic for domestic. So, it's something that really doesn't matter where you are. It's how people are going to be able to take care of you on these things. And I would just say if you're shopping around for an exchange company, obviously we're all going to sell what we believe our perceived strengths are. And I would say with Equity Advantage, it's just our investment background, its ability to solve problems and really take a look at your situation, make sure you're heading the right direction. And just quickly, an example of that conversation. Earlier this week, we had a deal that was closing right away. It had been set up by another exchange company. The client didn't direct that to happen, but it just got done because the escrow company had their closely held entity there, and so they just put the thing together for these people. And really, they didn't take the time to understand what was necessary. Well, we got involved with the deal because a broker introduced us to the investor. The investor wanted to use us, and we started asking, well, gee, who's on title of this property? And it was a situation where the property owner was actually dealing with some very heavy health issues, and his spouse was not on title of that property. Well, they'd been married, filing jointly for years, so for tax and legal purposes, she'd been an owner of the property as well as he, but she was not on there. So those changes need to be made, and the other exchange company that just handled it as a closing transaction, put it together just in his name, which was not going to take care of their situation and really was not correct in this particular transaction. Because if you look at the benefits and burdens of ownership were lying with both of them and had been for a number of years, but nobody really took a look at title and asked those questions about what's going to happen going forward and what needs to take place. So, this is one of those things where, even though it's 100 years old, people contact us a day after closing, which it's too late. If you have actual or constructive receipt of the funds, you're going to have a tax consequence. So you need to look at it. People ask me all the time, when do I want them to think about an exchange? I'm going to tell you when you buy the property. And it sort of comes back down to what Ron taught me, in the late 80s is answer three questions when you're going to buy something. What am I going to make? How am I going to make it? When am I going to make it? And I'd probably add another one, how do I want to own these things? Because if anybody that's on listening to this today, you've probably had partners in some context at some point in your life. And I would ask you if it's, for example, an investment partner, do you still have that person? And things change over time. Your needs change. And everybody's got to sort of look at it. You might be someplace today, but, back to where do you want to be in 2, 5, or 10 years? And how do we get you there? And investing is really the second biggest issue with 1031, second only to time. The opportunity costs that I mentioned earlier when we're looking at 1031, and this is why I want you to think about think about 1031 when you're buying the property, because you're most likely not going to own the property forever. So however you own that thing, that vesting, we need to have continuity of vesting through the transaction. So the person or entity, the taxpayer that gives us something has to be given something back. And often we might have a series of things happening during that time of ownership. You might be buying a property. If you're looking at 1031ing into a property, partnership interests do not qualify. So we could not exchange you into or out of a limited liability company. We need to use tenancy in common, for example. Now, I'm talking to you today from Oregon. Oregon's not a community property state. So if we have a limited liability company that has just spouses in it even, that is a situation where if you're going 4 units or less on an acquisition, financing is typically going to be residential financing in that situation. And if you're looking at spouses in the state of Oregon, you might start with an apartment or not an apartment, or it could be an apartment building, but you might start with a rental house. You get a second rental house and you get a third one, and then your lawyer says, gee, you know what, now you got a bunch of doors. So you probably ought to own this thing in a limited liability company to protect yourself. And, that's great, and that's sage advice. But it does create issues because, as I was saying, if you're buying 4 units or less, that's a residential loan typically, and now you're in a situation where that loan to a limited liability company is going to be more expensive. So it's not uncommon for somebody to give us a property, spouses in the state of Oregon, in a limited liability company, and then they go to get the financing on the acquisition side, and we tell them, hey, you've got to close it in as a limited liability company. Now they're upset. So I've been doing this for over 30 years at this point, so I'm not going to let that conversation happen later. I'm going to ask earlier. And that's just one of those situations where, people, like I said, companies are going to sell their strengths. A lot of the companies these days just want to say, hey, use us, we're huge, we've got a huge bond, and your money's safe. Well, really that's not taking care of you. I mean, anybody in this industry is going to be able to protect your money through a variety of different techniques. It's qualified escrow accounts are going to take care of it. Bonding is going to take care of it. There's actually special bank accounts for banks that work in this space all the time where they're isolating the money not just from actual or constructive receipt of the taxpayer, but it's going to isolate the funds from the exchange company as well. So there's a whole variety of ways to protect money. So use us because we're huge. We got a big bond. That should not be one of the qualifiers. I mean, it really needs to be, what are they going to do for you? And are you going to get the most out of that transaction? And when I talk about the opportunity cost of the exchange, you're saddling yourself. Time is the biggest issue with any exchange. You've only got 45 days from settlement to ID a replacement property or a group of replacement properties. You've got a total of 180 days to get the deal done. If you're doing a reverse exchange, you've still got the same 45, 180. It's just sort of a little screwy because you've got 45 days from the date of acquisition in a reverse to identify what properties you're going to sell, which 9 times out of 10, already. So that's sort of a pointless thing. Once in a while, we'll have somebody that's selling a number of properties and they're not sure which one's going to go where yet. But really, you're always looking at those timelines. The opportunity cost is what happens. You get to the 45th day and you haven't really found something, so you just put something in there just in case, or just because you don't want to pay the tax. And that's that opportunity cost. You're stuck in a situation where you got to get something done in a finite period of time, and that period of time goes very, very quickly. So that's why I'm saying you want to think about the exchange when you buy the property, because that's going to dictate sort of how you own things and ultimately where you're going in the future. Worst case, you want to think about when you contemplate a sale. And the first thing I'm going to tell you is talk to your tax people. You've got to understand the tax liability on a sale, because the exchange is not always the right thing to do. And by the way, we really work hard to provide information to help you, whether it's in an exchange context or anything else. If you have questions, our website is full of information on it. Our YouTube channel, we work very hard to get content up there that's going to help you out. A lot of that content has nothing to do with 1031. And you're saying, well, gee, David, why would you have something on cost segregation on your YouTube channel? Or why would you have something on opportunity zones on your YouTube channel? Because opportunity zone really doesn't work with 1031. It's sort of, maybe it's a safety mechanism if you've got a failed exchange. But we do these things, even selling life contracts. Why would I have a video on YouTube talking about selling your life insurance contract? Well, I never know where you need money, right? So that source of funds, instead of just walking away from your life insurance contract, letting it lapse, why not sell the thing to somebody? You've got more money to work with things. And so since I'm on the topic of opening up opportunities of money for you for different investments, take a look at our YouTube channel and our website on IRA Advantage, because that was a result of 15 years of our clients coming to us saying, hey, we're in an exchange with you, but we understand we can use retirement accounts to go buy real estate. How do we do it? Well, we put IRA Advantage together to help you with that situation. So if you want to combine 1031 money and your retirement account and common investments, you can do that. If you want to take your retirement account and go buy crypto, you can do that. Precious metals, obviously the real estate. If you're a mortgage broker and you want to use your retirement account to make loans, hard money loans, you can do all that stuff. So that's why we put the content out, because we really want to be a resource for you, whether you're in an exchange or not, or you're looking at doing something with a retirement account. Really, you don't know what you don't know. So we try to get information out there that's going to help arm our clientele with tools to get them where they need to be. And, there's lots of opportunities people just aren't aware of. So the only dumb questions the one you don't ask. And by the way, if you've got questions on something and you've dug through our libraries and you haven't found any information on it, give us a call or reach out to Seymour at 1031exchange.com, and we'll create some content on that topic, and hopefully it'll help you. And by the way, there's no cost or obligation to you to give us a call and talk about your scenario. So, as I said, I was taught, answer 3 questions before you buy something. What are you going to buy? Obviously that's the big one, but what are you going to make? How are you going to make it? When are you going to make it? If you can't answer the questions, don't buy the thing. But that's going to be the beginning of this stuff. And understand, if we're looking at 1031 in 2024, it's a situation where we don't know what's ahead. You've got, once again, that opportunity cost of the exchange. You're having to buy something in a short period of time. And we're in a market right now where we're seeing more seller carries, which a seller carry back, if you're in an exchange buying and somebody's going to carry you, great. But if you're doing an exchange, wanting to do an exchange, and you have to carry somebody, it gets tough. I mean, there's a variety of ways we can handle that note, but it greatly complicates the transaction. And really, what we've seen, as I said, it's July of 2024 right now, and we've seen a number of transactions just in the last month, let's say, where we had buyers coming in, a situation where we had an exchanger working with another company. Their 180th day was coming up, and their financing blew up. So we got involved and really got a situation together where, fortunately, they, even though they were working with a different company, they referred the seller of the replacement property to us because they knew we had a way to get them taken care of with the seller finance. So we actually restructured the entire deal at the 11th hour to get the 1031 client's 180th day handled. And our client, we just did a short-term seller carry and got them handled too. So everyone got where they needed to go, where really, with that financing gone, they were going to be stuck. The exchange would have been blowing for the buyer, and the seller would have lost a buyer that they really wanted because they didn't want to restart that process again. So, really, like I said, the only dumb question is the one that's not asked. And what we like to do in here, I'm just going to put it out to people, is ask these questions sooner rather than later. And a lot of times in today's world, people don't want to pick up the phone and call. Well, we can go back and forth on email forever and get places slowly, but in a phone call, we can get someplace very quickly. We can get the nuts and bolts of the transaction and get it taken care of very, very fast with that phone call. And that's the thing in today's world. Like I said, people don't want to talk. Give us a call, talk to us. Even if you're working with somebody else having a hard time with something, maybe we can help you out, and we're going to do what we can to take care of you in that situation. So it's one of those things, like I said at the beginning, the people that were involved in the business initially were people that really were mechanics in that space and really would understand that what is possible, and it sort of evolved, unfortunately, into an additional escrow function, and people are just taking orders and hey, what's your contact information and who's handling the escrow, and we'll put the deal together. That's not the way to handle this stuff. Really justify what's going on. Just before we start recording today, I'll give you another example of that, just a few minutes of talk and what's going on. So we've got somebody that has a transaction where they've got, let's say, $25,000 in excess of what they're buying. And it's a situation where, understand, 1031 is not all or nothing. And for total deferral, you need to go across or up in value and equity. I did not say anything about debt. Debt can go away 2 ways, one by going down in value, the other by adding cash. Either way is going to be fine. But, really you're just looking at going across or up in value and equity. So there's a $25,000 delta between the sale net of closing costs and the purchase price of that property. So the exchanger's broker called up and said, hey, we've done improvement exchanges through the years, or I've asked you these questions, how to get this thing done. Well, for $25,000 worth of work, an improvement exchange really is not justified. So in that situation, they might have said, if they didn't ask the questions, we might have had to set up an improvement exchange for it. In this situation, I said, look, for $25,000, the difference in cost between a delayed exchange and improvement exchange is probably about what the tax consequence would be if we did that thing. So my advice to them was, one, if we can get the seller to do the work, bump the purchase price by $25,000, we don't have to do anything, and it's been accommodated. Those improvements are done before close. that $25,000 gets added to the purchase price, but it's capital improvements, so that seller shouldn't have any tax liability on that. They're guaranteed that the buyer is going to buy it because they put, in effect, released hard earnest money, and the deal gets done that way. So that's the solution. Or worst case, we just close the deal, give the client the $25,000 as soon as they're entitled to it via 1031 G6, and now they've got all the time in the world to do the work. So I just want to stress, a lot of times people are just really, hey, can I spend more money? Can I pay more for the replacement property because I have boot and I'm going to have tax on that? Well, no, don't do that. Every dollar you spend more than you want costs you $1. If you don't spend it, maybe it's 30 or 40 cents on that dollar. So to have some tax exposure is not a bad thing. If you want to pull some money out, I had a conversation with an investor that we do. Actually, he's a client of ours on both 1031 and retirement accounts, and he was in the other day, and we're talking about, one, the opportunity cost of the transaction getting places, but really you're just looking at what is important, what the opportunity cost is, and where they want to go, and that tax liability is going to drive the transaction. Because if you don't know what the tax liability is on sale, how do you rationally do an exchange? I mean, you need to understand that. And by the way, having tax exposure on a disposition is one, it's exposure. It's not actually taxes owed until years in. So don't use your CPA come April 14th. Use them before the year expires. Maybe you've got some losses in the stock market to offset the gains in the real estate or vice versa. And all those things are going to be important. So talk to them before as soon as you contemplate a sale, you want to talk to them, understand the tax liability, then you know what's going on. If you put a property on the market and you immediately get a full price, let's say cash offer, they want to close next Friday, you think that's a great thing initially until you know, hey, I don't know where I'm going. Ask for the time you feel you need. Don't let things close any earlier. And by the way, you can negotiate purchases before the sale happens. That's not a problem. But, really, it's just planning things. If you've been on my seminars in the past, you've heard me talk about planning. Those who fail to plan to fail, right? You talk about if you scuba dive out there, the whole rule is you plan the dive the plan. If you're a pilot, you're going to file a flight plan. If you got boating, you're going to do float plans. You're going to be figuring stuff out, letting people know what's going on. And by planning, you're going to be much more in line with a success story, not a failure. And it's just really take advantage of the resources in your life. I think good tax people are some of the most important people in your life today. The tax world gets more and more complicated, and you got to love it where, for decades, the reporting limits for money was $10,000, and then all of a sudden a couple of years ago, we have now a situation where, we're just going after the big guys, and now you've got to report $600 transactions. That's absolutely ludicrous in today's world. Just think about the cost of enforcing that. I mean, how can that do anything but go backwards? And by the way, when I talked earlier about who benefits from 1031, I talked about obviously the investor, because every dollar they save, how much more do they have to reinvest? If you save them $1, maybe they got 3 or 4 more to reinvest. Well, how does that translate to commissions for brokers? Once again, if you don't get this transaction together, probably 20 years ago now, 25 years ago, I had a transaction out of Texas, and we got referred in the deal by the broker on the buy side, not the sale side. So the broker knew this deal, and this was, like I said, 20 plus years ago. I think it was about a $6 million sale, and which in those days was pretty big. So the broker on the buy side was saying, hey, the client's got to do this exchange, and he was assured that it had been taken care of. And so he was all ready to sell the guy the up leg. And what happened ultimately is that the brokers involved with the sale and the escrow company on the sale did not get the deal set up. So the client called us up, day after closing and wanting the transaction done. It's too late. The seller had to pay the tax obligation for that failed. It wasn't a failed 1031, just never got structured because they didn't get people involved. And that broker on the buy side, unfortunately, the conversations happen after the close, and now he ends up losing the sale to this person on the up leg because he no longer had the money to go buy that property. So who benefits from the transaction? Obviously the taxpayer. brokers, because if you've done your job, you not only know what the person's going to buy, you know when they're going to buy the thing. If somebody's in an exchange, keep in mind, if you're a broker, from the broker's perspective, understand who you represent. If you're the buyer's broker and being paid as such, you don't want the seller or seller's broker to know what else has been identified when you get to the 45th day, because imagine we're on day 50 and you're fighting over $10,000, and that seller or seller's broker knows that you've only ID'd their property and you have no ability to go do anything else at that point. They're going to dig their heels in. You're going to be paying the extra 10 grand, or you're going to have a failed transaction. On the other hand, if you're the listing broker and you've got somebody coming in via 1031, if I go back to 1990, we had the old RMLS books, the Realtors Multiple Listing Service books. We'd mine through those things, and you'd see a little box in there. One of the contingencies of sale might be 1031. And in those days, brokers might shy away from the 1031. And we always sort of look back, and I always laugh, the old saying, buyers are liars. Well, if somebody's a buyer coming off the street to go make an offer on a property, are they motivated to get that deal done? I mean, what's the glue to keep that deal together? Where if you find out you've got a 1031 buyer coming in to buy this thing and they've got an offer there, you're outside the 45 days, they have to get the deal done. So I'm going to put it out to you. If I go back 1990, maybe a 1031 buyer was looked at as something bad. I'd say today they're probably a big positive for you, because they're highly motivated to get the deal done. So who else benefits from the transactions? Well, I'll tell you, the renters do. So if you look at just the quality of real estate, anytime somebody buys or sells something, anytime something's sold, the buyer typically is putting money into that property. Maybe the seller had to put money into the property. Maybe the property wasn't financeable even, and it had to be improved to get the financing. But 9 times out of 10, I'm going to tell you that the buyer ends up putting money into the thing and improving the quality of those properties, which keeps the vibrancy of the whole market there. So when we're, once again, future context, July of 24, basically, across the board, we're looking at a situation where people need, low-income housing in lots of different regions. And it's just not there, because you look at the cost of building things, the cost of materials, everything else, the new stuff coming out of the ground is just too expensive. So you're looking at older properties, maybe BC properties, and we've got sort of a storm on the horizon just with insurance. So that's got to get fixed, all right? And this insurance issue, on older buildings, I mean, if you can't get something insured, how are you going to get it sold? If you're the seller, you can't get it sold. The buyer, you can't buy it because you can't get the insurance on it. You can't get a loan on it. So really, this insurance piece is getting to be a bigger and bigger issue. But the vibrancy of real estate is really greatly enhanced via 1031, because it increases market velocity. More turnover means more improvements, and just keeps everything vibrant. If that goes away, and the government is, back to Ron. I mean, the one thing he warned me about back in the late 80s, early 90s, when we're putting that thing together, he's just like, look, you got to understand, you're always a pen stroke away from extinction. And what he meant by that is every few years we get a new group of politicians in office, and they all think they got this genius idea that 1031 costs them a bunch of money, so they want to either get rid of it or they're going to shorten its application. I mean, shortening by the current proposals via Biden, or to cap annual deferral to $500,000 per person per year. Well, it just slows the market down and hurts. And really what they don't understand, and every time we, once again, elect a new group of, my father-in-law used to call them knotheads, we elect a new group of people, we got to fight for the same thing we just fought for. There should be some statute of limitations where they can't go out and propose something that was just failed recently, just years before, right? And they just keep coming back at it, and we've got to reprove it. So, ultimately happens is they think, well, gee, hey, if we get rid of 1031, we're going to have all this additional tax revenue. They don't factor in the fact that you're going to decrease the velocity dramatically. And so they're foregoing. Think about every transaction, what I've been saying about improving. So every time there's a real estate sale, who gets paid? Well, the tax people, the legal people, the finance people, escrow, the brokers, Home Depot, for goodness sake. You got all the people that are selling appliance, things that are being fixed, put in, installed, all the contractors that are there. You got new insurance deals going on. You got a whole bunch of people they're getting normal income tax from that they're not going to get normal income tax from if they get rid of the code. I don't know how many times we have to go through this. So I'll get off this topic, but just think about the vibrancy of the market and what 1031 does there. It really makes a huge difference for people. And ultimately, it increases the tax revenue to the government. And, it's just, at this point, it's over 100 years old. It's a great tool. And I really just sort of say, look, it's an IRA for real estate. And, once in a while, I'll get somebody in the financial world, the Wall Street world, complaining, well, gee, we don't have 1031. And, well, yeah, but they've got trillions, tens of trillions of dollars that are IRA and 401k funds. So that's all tax-deferred transactions. 1031, you sell something, you've got tight timelines. The other thing that they don't contemplate, real estate, I'm a real estate guy. Okay, Wall Street sort of drives me crazy. I got money in there, obviously, because diversification, you got to have that for stability and ultimately success. But if I buy a stock, I'm betting that it's going to go up. It might be a dividend-paying stock. It might do something else. But ultimately, if I buy gold, for example, I'm betting that it's going to go up. If you've been listening to this entire podcast, you heard me say earlier, never to bank on appreciation. So you're in a situation where with real estate, you don't have to. You've got somebody that's paying you rent monthly. You've got interest deductions. If you've got a loan, you've got depreciation you're taking. And at the end of the day, you're going to, just like an IRA 401k would allow you to sell a stock and buy a new stock without realizing tax gain in that situation, the real estate's going to do that via Section 1031. So it just keeps you moving, keeps you going, and at some point you sell, you pay the tax. So you get the ability to pay the tax when you want to pay it. And, there are tools in today's world. You just we still have stepped up basis on somebody becoming an angel. What I mean by that is if you exchange through your life and then you pass away, your heirs would get stepped up basis, current market value. And, when they inherit the property or properties, they could sell it with no tax consequence. Now, that's something that's here today. Don't know if it's always going to be there, but one of the complaints to Wall Street is, well, gee, we don't have 1031. We don't have that ability. It's like, well, yeah, but with real estate, the downside of it is you buy stocks, you're not paying tax on those stocks. Now, if the government gives what they want to do with the mark to market, then you're going to have unrealized gains tax, which is just absolutely crazy. What are they going to do? Give you money back with unrealized losses? I don't understand how they do that. Or once again, the cost of enforcing that would just be astronomical. But if we're looking at real estate, the entire time you own it, you're paying property taxes on it too. So, once again, you've got a situation where they're apples and oranges. Wall Street's one thing, real estate's another. Anybody that's really wants to be comfortably successful, you're going to have both of those things. It just makes sense. So I've been having a good time just sort of spinning my wheels on this. I think I'm going to sort of wrap up today by saying that, once again, David Moore with Equity Advantage, 1031exchange.com. But I encourage you guys, if you've got questions on different topics, real estate, give us a call or send an email to Seymour at 1031exchange.com. We'll create some content on what you've got questions on. But as I said before, the only real dumb question is the one that's not asked. You got questions, give us a call. And what I will tell you is in the tax world, it's rarely a question whether you can or can't do something. It's how you're going to get it done. And you're going to get it done by assembling a good team of professionals. I'm going to tell you on that team of professionals, as you've heard me say earlier, good tax people are critical. If you're doing, some crazy stuff, you probably need some good tax counsel on that team, good brokers, finance people, somebody that's really going to help you get those loans, get you into the properties, knows you, and can take care of you on that stuff. If you got income properties, you got a bunch of them, you're probably going to want a good property management company too. I mean, somebody that understands you, the owner of the property, are their employer, not the tenants, right? So obviously, people have issues with different situations there. But I'm going to put us on this team too. And, good escrow people. So somebody, I was actually one of my favorite escrow people recently retired. And it was funny because the founder owner of the title escrow company was saying, well, she did all his transactions too, and now what's he going to do? But he's got a whole team of good escrow people anyway. But having good escrow people that are going to take care of you, you can give them a call, and they're going to understand you and sort of your MO and really take care of you. That's great. I guess one last comment I will make, and I got to thank, let's say, the National Association of Realtors for really pushing to probably get, number one, to keep 1031 alive, because we couldn't do it without you. The Oregon Association of Realtors, Oregon Association of Realtors saved 1031 on actually the difference. So in the late 90s, Oregon would discriminate between residents and non-residents. Oregon resident could exchange out of state with total deferral, a non-resident couldn't. And that thing got sort of flipped around, some legal action one of our clients took in the late 90s, sort of flipped that upside down. The state was going to just tax everybody out that was leaving the state, and that's not the case today. If you got questions, different state applications. Some states have clawbacks today. Oregon's one of them, so you can defer your gain out of the state into a new property. Maybe you go from, in the early days, you could exchange out of Oregon into, let's say, Nevada, hold a property for a year or two, sell it, take the exclusion if you converted it from investment to residence, and get rid of all your gain. Or you could just do the exchange into Nevada and hold it for a year or two and sell it, and you'd save yourself almost 10% tax. Well, that doesn't work anymore. And California's followed that. There's other states that are looking at it too. But just understand, what you're doing with these things, and ask those questions. But really, it doesn't matter where you are. We're going to be able to help you out, and I just encourage you to give us a call with questions, ask those questions you've got, and really take advantage of the professionals in your life. And I really look forward to working with you in the future. David Moore, Equity Advantage, 1031exchange.com, and have a wonderful day. Bye-bye.